to actually get money to pay the interest or to pay down the loans enough so they can get to a profitable position.
And I think they're also referred to as a zombie company, whereas they are just barely making their payments on their interest payments on their loans. And so they're not making any money. And there's plenty of examples out there.
Which is interesting because isn't that how the federal government's operating financially?
It's even worse. It's even worse.
Right.
Than that.
That's the type that they're all following, and it doesn't work for the government. Why is it going to work for a company?
Nobody cares about it. Nobody in the government. Let me restate that. No one in the government cares about the debt where we're at, that it's not payable, any of that stuff. But us as individuals, as individual families, we have to be hypersensitive to our own debt, to whether we can make it from month to month. Our goal is not to live from paycheck to paycheck, from month to month, right? It's to build a savings. Have 3 months, have 6 months, have a year's worth of savings, have a year's worth of food storage, or even go back really far, 7 years worth of food storage.
We look to the past to prepare to for the future, and you look back at your grandparents, you look back at my grandparents, you look back at their parents, and how did they strategize their finances? How did they budget?
Well, let's jump right into the housing.
Okay,
I think that fits perfectly.
Oh yeah. Well, my grandparents bought their first house for I think it was $2,000.
My grandparents, I think they spent like $6,000 or $8,000.
Yeah,
on
and
their
and this is up in Idaho Falls, Idaho, and then their second house they bought for like $3,500, $3,600, and they lived there and raised their family there until about 10, 15 years ago. They finally moved, so they were there an awfully long time. That's where they raised all 5 of their kids, and then I look at my parents. My dad, he built his first home in Idaho Falls, and I remember it was like around $25,000 for that house. Unfinished basement, but it was like a good 2,800 square feet, I think, for the whole house. Then we moved to Colorado.
Living posh then, right?
And
move up from the little farmhouse to the 28 square.
Well, no, my grandparents' house wasn't a farmhouse. The farmhouse was the generation before.
Oh, okay.
So I'm the third generation off the farm. My grandparents are the first generation off. But the interesting thing is we bought our house in Colorado for like $78,000, and that was back when my dad would make about $35 a year.
So again,
this
still
is
about
1984.
Okay, and it's still about 2 years worth of income is what the house, what the price of the house was.
Yeah.
So for many decades, the average price of a home was about 2 years of a standard salary.
Well, here's the interesting thing: it was probably a little over 2 years. It was probably like 2.5 years worth of income to cover the cost of the whole house, right? But the interesting thing is when they sold it. My dad's not making much more than where he was then. The housing industry has changed completely. He's now making, now he's mostly semi-retired, but he went from making $40,000, $50,000 a year and having a house, same house he bought for $78,000. He had $180,000 in loans on it when he sold it. Because you refi and you take money out to survive, to get by.
There's that evil word, equity.
And you utilize that equity, which is really you're just taking a loan against yourself, because equity doesn't exist until you sell the home. It's all mythical and magical until then. Anyone that tells you otherwise is trying to get you to take out a loan.
Yeah, the real estate industry in general. Scott and I know this industry well, and of course, lending industry, banking industry. They try to convince us to say, look at how much equity you have in your home. Let's utilize that equity, And
you can get new windows. You can get new doors. You can get a new car.
You can take that money and buy another property with it and leverage that property. But this is one thing I always told my clients. They would ask, is it now a good time to buy? I mean, prices are pretty high. Not that I'm not doing real estate anymore, but my advice to them was, debt is not a tool, and your home is not an investment. Because, again, going back to the survival rules of 3, you got to have shelter. That's number one. You got to have shelter. So
it's
that's
a staple of
belief.
life, not an investment. Rental units, rental apartments, those are investments.
Absolutely.
But your primary home, you cannot treat it like it's an investment.
And tool is not a debt. A debt is not a tool.
Tool is not a debt. You can buy tools on debt.
Yeah, you can.
It's dumb, but you can do it.
There we go. And buying anything on debt is dumb. So we're talking about kind of current
housing
market, and of course here in Utah, that it's always been a hot topic. I got my real estate license in '94, and kind of rode that into the early 2000s, and things were so hot in the early 2000s up until 6, 7, 8. I couldn't compete. I mean, it was so hot, and we were doing land development. My dad and I were doing land development. We couldn't buy anything because the price was going up so quick that we were outbid on everything we tried to get. And so, looking back, hindsight's 20/20, and now I can see the mania for what it was in the time. It was truly a mania. Can we then see that where we're at now? Or is our vision clear enough to where we can see clearly enough and compare it to what has happened in the past? Or are we blinded again by the thought of having so much equity in our homes that we can use it to buy boats or go on vacations or whatever?
The equity, the financial situation is blinding, but also the status of home ownership.
Mm-hmm.
If you watch TV, if you watch the news, it's like now's the best time to buy a home. You need to own a home.
Mm-hmm.
It's more about the status of home ownership.
Mm-hmm.
And I think it's funny because the millennials get beat up left, right, and upside and down, right? And
Mm-hmm.
we tease the snowflakes section of that. But the larger portion of it are probably the more fiscally responsible demographic
Mm-hmm.
than I've ever seen. Purely because they've seen the crashes that we had before, and they go, I don't want that.
Mm-hmm.
They see their parents struggling over their finances,
down.
and they're like, I don't want that. In fact, I met a couple of girls the other day that they're just about to finish their bachelor's degrees, and both of them are like, oh no, I'm looking to do a tiny home and travel the world
Mm-hmm.
and work remotely. I don't want to have to be torn down by one job for the rest of my life, and I don't want to be stuck in this $180,000, $200,000, $500,000 mortgage
Mm-hmm.
when there's life to be lived.
Well, ever since the Great Recession, home ownership has dropped dramatically. I think right now it's at like a 50-year low, and I think it's like under 65%. Don't quote me on that, but from what I understand, it is in the low 60s, and it's a 50+ year low. So that's the toll that the previous recession, we won't call it a collapse because it should have been a collapse,
right? And obviously
that's the toll that it took on the real estate market,
right?
And even now, after 10 years of recovery, I'm doing the air quotes, finger quotes, of recovery, we still haven't, that home ownership is still extremely low.
Well, and it's crazy because I told you earlier, I got an email just the other day.
Mm-hmm.
Stated income loans are back.
Yep.
And I'm like, are you kidding me? It's a variable rate loan that goes up after a year. And I'm like, okay, so your payment's what, $2,000 this year, but what's it going to be next year?
Mm-hmm.
$2,400? $2,800?
Readjust depending on where the interest rate. And we know the interest is only going up from here. Whether the Fed continues to raise rates or whether the market itself drives it up, which is going to, because banks, another factor is these banks who are giving out these loans, their stocks are going down, their share prices are going down, their value is going down, because they're essentially insolvent. They don't have the equity, and they're over leveraged just like everybody else.
Well, and that's because of the policies for the banks.
Mm-hmm.
They have to leverage to a certain degree, or the federal bank system will not allow them to receive more money to loan, which is where they make their money. They make their money off of interest rates, and they make their money off of fees. Mm-hmm. And that's why they're so hard to argue with when it's an overdraft fee or wire transfer fees. Like they try to nickel and dime you everywhere. Why? That's how they make their money. But we didn't have banks. We didn't need banks. Mm-hmm. A long time ago, people saved money on their own. They invested on their own. They borrowed from private lenders or from family, someone else who had when they needed to, and paid them back quickly. Quickly is the operative word. Mm-hmm. And now our market's leaning right back into the same problem we had before. And in other states, it's already going down.
Mm-hmm. That's correct. Yeah, in the major metropolitan areas, East Coast, California, parts of Texas, the foreclosure rate is going up.
Yes.
It's started to go up. And mortgage applications are going down. Interest rates are obviously going up on mortgages. And so they're coming up with everything they possibly can, like going to stated income loans again to try and generate more business, more loans.
Yeah.
And my question is, why? Because they've seen what happened before. So why are they doing it again?
Well, they know they're going to get bailed out if there's a problem, right?
They think they are.
They've been trained to believe that way.
Yep.
And they know the only way for them to make money is to open more loans and then sell those loans off to other banks.
That's a good point, because just to say, for these banks to stay solvent, they have to increase their business. They have to grow. They can't just maintain on their their current income, collecting payments, interest rates, and what are their loans that are out there now. They have to continue to grow, and just like our GDP, the United States GDP, and all these other countries, it has to grow. And I've always thought, okay, we're in a recession or even a depression, where our GDP is stagnant, or it's even going backwards. I've always thought, okay, what's wrong with that? Life is that way. There's ups and there's downs. Why do we always have to be growing? And if we're not growing, we're in recession, and that's bad. So I've always wondered that, but I've learned what the truth is. The truth is, because things have to grow every year because of inflation, because of interest, because of debt. And so, looks like we've got a caller we want to get on the air here. Hang on a second. We'll since we're at our temporary studio here, we are figuring things out as we go.
So our caller just called in. He didn't want to go on the air, but he asked, what is your feeling on credit unions?
No, that's a great question. I think credit unions are inherently more safe than large banks.
Slightly more safe, because they have different laws they have to abide by. They don't have to go through the federal FDIC.
They don't have as many regulations.
They have less regulations. They're membership voted and run, so they have to continually work for the benefit of the I guess the people that have their money there, right? So I like those better than the regular banking system, but not by much.
They are still FDIC insured, so they're still subject to what's the right way to say it?
They're still subject to the major markets, to the
markets, to the industry, to the banking world, to the financial world. They're still right, and it depends on what they've done with. But
they're not as insured
their money
as high. Money. So it's a different amount that they're insured to. The other problem is they're smaller, and so anytime that there's a financial crisis and there's runs on the bank,
it's going to hit them a lot harder.
It's going to hit the credit unions and knock those out first. The big banks are going to fail and fail bigger, and it's going to hurt a lot more people.
I believe that's true. Thinking back to the Great Depression, those times, the first institutions to go out of business, I believe, were the small credit unions and the building and loans, like on.
And here's the question: why? Why did they go out first?
Well,
who were their creditors?
I see where you're going with this. Their creditors were you and me.
Well, their creditors were the bigger banks.
Okay.
The federal banking system, the larger banks, the international banking commissions.
They would still bank with larger banks.
They still had to have their money go through somewhere else. They still have to get their approvals from the other corporations. And when those guys are hurting, who are they going to do? What are they going to do? They're going to squish the little guys that need to give the money back to them. The same thing our banks are going to do to us, is squish us and be like, sorry, that's just how it is.
And that's a fact and I'm sure many of you have already heard of what bail-ins are, bail-in documents, that all banks, and I believe it applies to credit unions as well, are basically, when you're a depositor, you are not, and maybe credit unions are different this way, I don't know. This would be something to find out. But in a big bank, like Chase, whatever, when you deposit your money, that money belongs to the bank. It does not belong to you. You are an unsecured creditor of the bank.
Well, let's
you're
back it up.
Lowest priority,
further, right? No dollar, no $20 bill, no printed
He's opening his
document.
Wallet. He's pulling out a
belongs
dollar bill.
to us. Let me explain this. This note is legal tender for all debts, public and private. It is owned by the Federal Reserve because it says on the top, Federal Reserve note. What do we get a note for?
Well, when we go to buy a home, we sign a trustee note.
This is a promissory note that it could have up to $1 value and can be used, according to the Federal Reserve's rules, as legal tender for all debts, public and private.
It is owned by the Federal Reserve and is due back to
not our money.
With interest.
And so we're only just walking around holding the Federal Reserve's money.
So what we're discussing is really, I think, all of the little factors that are building up and piling up to the next crisis, to the next housing, and not just housing, in all financial markets.
But I think the housing crisis is coming quicker.
It's a leading indicator, absolutely.
Yeah. I think it's coming quicker. It's going to be the first of the dominoes to really fall and be an issue.
Excuse me, the most obvious to see.
And I think it's something that can be fixed, but eventually we're going to be on. We're already on borrowed time because of the way that everything's being inflated. But eventually there's going to be a larger collapse.
And I guess let me say, kind of like my same advice to when I would advise my